For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
Managing Your Financial Future, as always, your podcast host, Johnny Dean. Welcome back. Another edition of said program. Happy to have everybody here with us. And that us includes this fella right here, Professor Rick Plum, certified financial planner, professional. They make me say professional, but I actually, you are a professional. I mean, you know, that's what they have us say, certified financial planner, professional. But I will put you in the professional category. Good enough?
When it comes to financial planning, I'll go with that.
I would too, especially on today's topic, because today we're going to show exactly how special you are, just how professionally special you are, and how well you know the bucket strategy. What I thought we would do today, we've been talking buckets for decades. I don't even know how long. And obviously, as markets go south or south-north, or whatever it is, people tend to look for ways to avoid, if not the volatility, the negative effects of volatility, which, in other words, they're trying to avoid ultimate risk. And they turn to strategies like a bucket strategy. And I would like to say the bucket strategy, because there really is only one, Professor. I shouldn't say there's one, but there's one way to do it.
There's one correct way to do it.
Yeah. And there are many varieties. Everybody's bucket strategy is different. I don't want to imply that they're not. But what I found was that there are questions out there about the bucket strategy, and some really good questions that I think other people who just sort of do a quasi bucket strategy can't necessarily answer. And I've given you some of these questions, Professor, but just ahead of time, would you agree with that statement?
Well, it comes down to the understanding of how buckets work in the first place. A lot of people think that having a bucket number one, which is what we look to draw from for the first 5, 6, 7 years, depending on where we are in market cycles, it really only needs to be about a year. You have about a year of cash, and then about a couple of years in something moderate, and then the rest can still be in growth.
Oh.
Okay. By definition, you've got 3 buckets there, but they are not filled correctly. They're not giving you enough downside protection when you don't have a sufficient time horizon for that bucket number one. And so some people, to say that there's only one bucket strategy, the bucket strategy is having some safe money, some moderate money, some long-term money, and identifying the time horizons. The difficulty is in those time horizons, and most of the ones that I read about online are way too short for that first bucket. And when you consider the average length of a downturn is 1.5 to 2 years, and having 1 year of cash, even 2 years of cash, all that does is get you to the bottom. Then where are you going to get the rest of it from? Something you have to sell at a loss. Yeah. Selling at a loss is what we're trying to avoid.
Well, we are. And these are some questions that I have found from others who have asked questions. Some of them, they've asked us directly. And I think some of these go back 3 or 4 years, but they're still relevant and they're still really good questions. So what I want to do is I've kind of separated these questions about buckets into a group of basic questions. I don't want to say too basic, but somewhat basic questions. And then we have fewer, but some, I would say, more advanced questions about buckets. And so what I thought I would do is start, at least today on this episode, let's start with the more basic questions that we get about buckets. And they're basic common questions. And I think these will perhaps generate further discussion about buckets from people who are listening to this podcast. And perhaps on the next one, I don't think we'll have time to get to all of these, but on the next broadcast, we'll get to some of the more advanced ones. So that's what I want to do. I think it's a good thing to do every so often, not just talk about how a bucket strategy works, but talk about how you, Professor Plum, and your colleagues at Lucia Capital Group, how you would respond to these questions when you're putting together a bucket strategy. So let's run through some of these here. No particular order of importance or anything like that. But I'll start with this one here. and it's the question is, how do you know when it's time to refill a bucket? I mean,
well, that's an interesting one, because as we talked about briefly before, bucket number one is a drawdown bucket, and it's the money where you're going to pull from principal and interest over a specific period of time. That time for some people is 1 to 2 years. I think is way too short. We typically are looking at 5 to 7 years. And so if we're using the 7-year time horizon, no matter what time horizon we're using, at some point we're drawing principal and interest out of this. You're not going to be able to continue that. You're going to have to refill that bucket. So when is the appropriate time to refill the bucket? Well, that somewhat depends on what did you invest for bucket number two. Bucket number two has a job. The job of bucket number two is to sit during the period of time that you're drawing down bucket number one, hopefully earn a better rate of return than you can get on assets that are liquid and safer as you have in bucket number one, but be available as you get close to the end of bucket number one so you can refill bucket number one. Its job is to refill bucket number one. So when do you look to refill bucket number one? Well, it depends on what I've used to invest bucket number two in. If I've used a guaranteed account, long-term account, maybe a fixed annuity that's paying 5% for 7 years. I don't know what the numbers are right now, but if you're a conservative investor, that may be where you go. You know for a fact that it's not going to lose any money. It's not subject to market conditions. You may wait until the last possible minute. You've got that full 7 years or 5 years, however many years you've got to go on of guaranteed return. You wait until you need to replenish. On the other hand, many people use a balanced portfolio for bucket number two. Balanced portfolios have a little bit better earnings potential, but also have some volatility with them. And so we're looking at, we don't want to wait till the very, very last minute to refill, because what if 2 minutes before the very last minute, the market goes down and the balanced portfolio goes down a little bit?
Yeah.
We don't want to sell into that either. So when we're using a portfolio in bucket number two that has somewhat of volatility in it, some measure of volatility, we're looking for opportunity. We know that we've put a barometer on bucket number two. Bucket number two, we expect to earn X percent, depending upon what the underlying investment is. If we have been at or in excess of that expected earnings, well, then that's a time to potentially bring money from bucket number two back into bucket number one. If you expected a 5 or 6% bucket number one, or two, excuse me, and you did 10, 10, 10, 3 years into it, you're up 30% where you thought you were going to be up 15%. Now may not be a bad time to take some of that excess return, refill or at least partially refill bucket number one, extend the time horizon out a little bit more for both bucket one, which would then obviously extend the time horizon for bucket number two.
Yeah.
The same thing can be said for bucket number three as well. When do you sell bucket number three to refill either bucket number one or two? And that is when it's opportunistic. We have time to wait out downturns, but that doesn't mean that you're Murphy's Law incarnate and you're going to have nothing but a downturn going forward. There's going to be good times too. So by understanding what we've set the expectation at, we expect, that we put $400,000 in bucket number three. In 7 years, we expect it to be $800,000. That's a 10% return. Maybe it's $1.1 million, $1.2 million. We're way past where we thought. Let's take some of that excess return and spread it out across bucket one and two to refill and stretch out our time horizon. But it takes understanding where you were expecting to be in the first place.
So really what you're saying when you're talking about refill a bucket, it really has to do, for bucket one, it has to do, well, how is your bucket two doing? If your bucket two is doing better, maybe take some and refill when it's doing it. When do you refill bucket two? Well, it's going to depend on bucket three. How's that doing? Is it doing better than expected? Maybe take some of that off. And really what you're trying to do is buy time. And that's really the whole gist of this, Professor, is buying time. That's what the bucket strategy does for you. And it provides you an income, a cash flow, all at the same time. So did I sum that up properly, would you say?
You did a very good job.
Okay. Yeah.
It's like you've been listening to us talk about this for 30 years.
Almost. That's true. Now it must have been 34 years. Wow. All right. So that's good. Great question. I hope that answers it for you folks. Here's another question that we've had, and this is a little bit more recent. Is the bucket strategy relevant in a high interest rate environment? Now, I don't know what they mean by relevant, because to me, I mean, relevance it's never irrelevant. But I think what they're asking is, how is the bucket strategy different, or is it different in a higher interest rate environment? Now, we've seen low interest rates forever. Interest rates now seem high because relative to the last 15 years, they are. But, I mean, if you went back to the 1980s, early, I mean, you can answer it in any which way you want, Professor Plum, but how would you address that question? Is the bucket strategy relevant or different in a high interest rate environment?
It might be considered a little bit slightly different. We use things a little bit differently in different investments, obviously. But it's not different in the sense that we don't change the underlying fundamentals of the strategy. The nice thing is that we can actually earn a little bit of return on bucket number one while we're using it over that first 5 to 7 year period of time. Go back 5, 6, 7 years, and we were earning very little in bucket number one. And so some of it has to do with the inclusion of alternatives and whether you use the income from the alternatives. But in a general answer to what you're asking, no, it doesn't affect the buckets. It just means you can earn a little bit more in bucket number one, and it may give you a little bit better overall return going down the line. Because instead of earning 0.05% in savings accounts and CDs and treasuries, now you're earning 3.5% to 4.5% in those same accounts. But the long-term expectations on the buckets 2 and 3 are probably very similar to what they were even in the lower rate environment. It's just a matter of the fundamentals still work. The fundamentals are still there. You just have a little bit better feeling about keeping some money in bucket number one. One of the hardest things was the emotional aspect of keeping money in a lower rate environment, especially when the markets were going up in some of those years when the interest rates were down. And it seems like, wow, I'm really missing out on something right up until the markets come down like they did in 2008. 2018 was a down year. And if you're drawing money out of your portfolio in those years, you're hurting yourself. So we want to have that money in the safer environment, regardless of what the interest rate environment is. There are some advanced areas, as I mentioned a minute ago, where you may be using alternatives to help create some cash flow and create less of a reliance on bucket number one, which is a distribution of principal bucket as well. But that's more of an advanced. We saw that happening when interest rates first started to go down in the early 2000s, where we could enhance the overall return with lower the volatility, increase the cash flow, and have less reliance on bucket number one when interest rates were zero. Now that we've got at least average historical rates of interest rates back, it makes it a little bit easier.
Yeah, and one of the questions that came out of that too was, when interest rates were first cut, I mean slashed, and that was the 2008, as they tried to bounce the economy back and get people spending again. 2008 interest rates were low, and the market was not doing very well at that time. So what you wound up with, I think, is a bucket 3, which is long term, but people would get concerned, and my bucket 3 isn't really moving. In fact, some of it's going down. And I can't earn anything in bucket 1 very much because interest rates have come down so far. So I guess that's part of the question is when interest rates are high and you're earning a lot on your fixed well, I'm not going to say interest rates are high. Now, if we go back to the 80s, I remember a friend of mine picked up a CD, a 10-year CD at 12 or 14%. I can't remember the exact number. Anyway, okay, that's higher interest rates. That's, those are stock market alternatives at that point because the stock market averages, 10-ish over long periods of time, and a 10-year CD earning 12, 14%. That would be a stock market alternative. We don't have that right now. So those are high yields. Those are high. Those are high. And as I said a bit ago, when you say high interest rate environment, we're technically not in a high interest rate environment.
No, we're in an average.
We're actually average, but it seems high compared to before. So your answer in that particular situation, Professor Plum, how does it change in a high interest rate environment? The strategy really doesn't necessarily change itself, right? I mean,
no, the strategy stays true to its calling.
Yeah.
In that you have bucket number 1 for distributions to spend. You have bucket number 2 to refill bucket number 1 when it's appropriate time. And you have bucket number 3, which is long term and has the time to go through those downturns that are inevitable.
Yes.
They're going to happen. Well, we just don't know exactly when or for how long.
Well, they are. Now, this is going to lead into the third question. And we've answered this many times, and I'm going to throw it out there again because it still comes up. And the third question about buckets that we've gotten is what happens if the market crashes while I'm drawing income from my buckets? Well, we're kind of seeing that now. So what
happens? Nothing.
Yeah, nothing.
That's why you did the buckets. That's why you created 5 to 6, 7 years of distributable cash in bucket number one. Why you used a more moderate portfolio, maybe even a guaranteed portfolio in bucket number two, to do what you said earlier, buy yourself that time, because the worst thing to do in a market downturn is sell because of a market downturn, or have to sell because of a downturn. If you sell, it will never come back. The money you have won't come back. The markets are going to come back. Mm-hmm. At some point, they'll come back. How long? I don't know. But so far in history, the longest has been 10 years.
Well,
when we had the 73, 74 downturn, which was very dramatic for those that were there. And it took almost 13 years, but not to get back to even, to get back to what T-bills were paying, to get back to the risk-free rate of return. So that's why we use 10, 12, 15. We like 15-year time horizons, so that even though the market may be crashing right now, the biggest question isn't, oh my gosh, is now a time to get out? No, that's the exact opposite. The good question is, when is it going to be a good time to get in?
Yeah. Now,
I don't want to sell anything. I want to buy into this. There's a sale at pennies. Come on.
When you said nothing, and I know what you mean by that, when I say what happens, the answer is nothing. That doesn't mean that your bucket three isn't going down. That's not the issue. It
happens.
It does happen, and the bucket three probably will go down depending on how much you're invested. But the when you say nothing happens, it's because what we're saying is, first of all, nothing happens with the strategy. And the second thing is, nothing happens with your income, which I think is what most people are concerned about when the market crashes.
Cash flow stays the same.
Cash flow stays the same. And I think that's the important part of this that people need to realize, and why it's one of the things that we've talked about so many times. Why buckets? Well, this is why. We're seeing it now, and we're going to probably see it again sometime. I mean, it's just what happens, and that's why it was designed that way. So your answer is, what happens if the market crashes while I'm drawing income from my buckets? Nothing. And we'll stick to it.
You keep getting your cash flow. Mm-hmm. You keep going to see the grandkids when you want to. You do your traveling as you expected, because your cash flow isn't affected. And you've got 8, 10, 15 years for the market to recover.
Mm-hmm. And you may see
it will probably have recovered and dropped multiple times over that period of time.
I was going to say, you may see a recovery and another drop during that period of time, and that's why it's there. A couple more questions here on buckets before we. Time is flying on this episode. But these are wonderful questions, and I think they help people to understand a little bit more when we do talk about buckets. Let's see. Oh, here's one. The question is, how does the bucket strategy adjust if I have multiple income sources like Social Security and a pension? Another great question.
Well, the bucket strategy isn't adjusted because of those. It's created with those in mind. You know what your Social Security is or is projected to be, and when you're going to start taking it, or at least that's a discussion to have before you actually fill out the buckets. Because the whole idea is to identify what your overall need is, and then each year, what is my need each year? And that need may change. My need may be $8,000-$10,000 a month for the next 10 years, but 10 years from now, my $2,000 a month mortgage is going to go away, so my need will come down. Identify, basically model out what your spending need, including the fun things and taxes, are going to be over the next 15, 20 years. And then figure out what your incomes are going to be in those years, not the portfolio, but the incomes that the only control you have is when you start them. Do you start your pension by this time? Do you start your Social Security this time? And so you look at what those incomes are. Now, for most people, there's going to be a delta between the two numbers, the total income that you've got coming in any given year and the total projected need in that same year. That difference is what needs to be provided by your portfolio. And the difference may be different every year, because your income you may start your Social Security at 62 and then your pension at 65. And so you need a little bit more money from your portfolio in the early years, less in the later years. And you set up your buckets to handle that income deficiency from other sources. Now you've got your income, you know how to set your buckets up. I would say for a lot of people, especially going into retirement, they should, what I call, pad bucket number one a little bit. So if let's say you needed, $10,000 a year from bucket number one, you want 7 years, so you put 70,000 in bucket number one. I'd put more than 70,000 because you're just going into retirement. You haven't exactly experienced it yet. You think your expenses are going to be X. They may be X plus, they may be X minus. I don't know yet. You don't know yet. So let's give ourselves the ability to have flexibility to adjust for our spending needs. Now, once you've been in retirement for 10, 15 years, you get a really good idea of what you're spending every year. Now you can be a little bit closer on your projections because you know what you're doing. You've been there. You've experienced the retirement. You know what's going on. So, but the numbers come from the need. The need comes from what the portfolio has to provide over and above what your other income sources provided any given year.
Yeah.
So we take them into consideration. But I remember years ago, people were talking about use your Social Security as an asset. And so you calculate the present value of your Social Security payments, and they're $400,000, and you have $500,000 in your 401k. So you really have $1 million. And so in a balanced portfolio, you should have 50-50, 50% stocks, 50% bonds. That means your Social Security are like the bonds. That means 100% of your portfolio can be stocks. That's BS. That's just the most stupid thing in the world. First off, how do you calculate the present value of an income stream? Well, one thing you have to know is how long that income stream is going to last. Do you know how long your Social Security is going to last? To the day? Or I should to the month. No, unless
what you mean
when
is
you're going to die, you don't know.
Yeah.
You can't even do that calculation.
Yeah, what you mean is how long you're going to live in that scenario. And nobody, obviously, I would hope nobody really knows that.
I hope not.
No. So you mentioned the word flexibility in this case. Flexibility is what I would call room for error. And it's one of the biggest things that you can do. It's one of the best things I believe you can do that your strategy can do for you. And this is a big part, I believe, of the bucket strategy. Room for error. I mean, if you have a strategy that's complicated, simple, it doesn't matter. But if everything needs to fall in line for your strategy to work, in other words, the markets can't do this, interest rates can't do that, you can't need more spending, you can't need less spending, whatever it is, that strategy is most likely going to fail. You need something that's got room for error, a margin,
right.
flexibility.
Now, I'll say that's part of it, room for error, but I want to use room for error as the overriding thing because when you get into retirement, it's not about error. It's not always error. Things change. Life changes. You change. You think your spending is going to be X, but you decide that you really like traveling. And you want to do more of it.
Well, and that's what I mean by room for error.
That's not an error.
No.
That's just you haven't been there yet and you don't know.
No, room for error doesn't really mean mistake in this case. Room for error means room for change.
Room for change is a better word, but room for error is there too. You can't run it so tight as you were talking about that it requires a specific, you have to get these returns or else nothing's going to work. Unfortunately, that's what a lot of people look at when they say, well, this fund has averaged 10% for the last 30, 40, 50 years. It's going to average 10% a year every year going forward. And if you actually look at it, it doesn't do 10 in any one year. It does 12, 8, 20, minus 5. It's all over the place.
Yeah.
That is not a good way to plan a retirement.
No, it's a terrible way to do it. And if you're meeting with somebody and they say, hey, listen, you're going to be just fine. Everything's going to be just great. You're going to be perfect as long as the markets do 12% a year every year for the next 20 years. Okay, thanks. Goodbye. I would run. I would run in that scenario. Okay, we got time for one more question here. And this might be my favorite of them. Only because I'd say it's very insightful. The question is, does using the bucket strategy mean I'll earn less over time compared to being fully invested? Now, Professor, we have talked about this as well on when we talk about the whole sequence of returns deal. If you retired in 1969 versus 1979. And if you retire at a good sequence, just about anything will work, and you may wind up with a ton of money because you don't have as much in safety. I'd like you to address this. We've only got maybe 5 minutes left or so in the podcast, but if you could please talk about this for a moment.
Well, there's the two sides to this answer. One's the tangible, one's intangible. The tangible are if you actually do what the markets do and you have nothing but good returns going forward, you may end up with a little less money. By being a little bit more conservative to protect against a downturn that in that case never happened. On the other hand, when was the last time downturns never happened? It's very rare. And more than often, downturns occur. And so if you have downturns, the buckets will do better than not having buckets by, or doing a systematic balanced approach. So will you end up with less money? I don't know. Tell me what the market's going to do over the next the next 5 to 10 years. Mm-hmm. That will dictate whether or not you end up with a bigger or smaller legacy for your heirs. If there's any down years, you'll do better with the buckets. Now, on the other side, that's just looking at the tangible, specific numbers. There's the other side to it, and that's the emotional side. And even if we get minor downturns that look like who knows what they're going to be, if you know you've got your cash flow stable, you're less likely to sell out of the market during downturns that may be there, or even slow times. It doesn't even have to be a negative, but slower than expected times. But if you're relying on that portfolio and you're taking 4 or 5% a year out and it only does 2% one year, you're thinking, oh no, I'm going backwards. I've got to, the market's going to go to heck in a handbasket. And the emotional side pushes people to sell at inopportune times when they are not secure with their income streams. And so from a emotional side, buckets help us stay the course through downturns and allow us to recover, being more rational investors and have bigger legacies for the future than people who do systematic withdrawals on balanced portfolios. The numbers don't show that. That's the emotional side that's hard to quantify. But from both sides, the only time a non-bucketized approach works better is when you have no downturns and you do equal to or better than average every year for 10, 15 years. Mm-hmm. How often does that happen? Never.
Well, it hasn't happened yet. I mean, I guess
it could. You want to bank on that?
I would not want to bank on that because once again, now you're getting into the gambling portion of it, and we don't want to gamble with our future in this way. So, will you end up with less money over time? You did I don't have time to get into the whole thing, but when we had our sequence of returns discussion about retiring in 1979, 1989, whatever that is.
Right.
And you took this out, I think, 30 years.
I went 30 years, yes.
And I believe the bucketized version had only about, I'm going to get the number wrong, but it wasn't all that much less than
it was about 509,000 in my example compared to 598,000.
Yeah. Okay. So over that time period,
17% less.
Yeah. But see, what you've bought with that is
compare that to using the same strategy for somebody who retired in 69 that was broke after 20 years, not bucketizing, and still had their original 100,000 left over after 20 years, after 30 years. They had almost 200,000 after 30 years compared to being broke in 20 years. Which side is worse? Being broke after 20 years or having, $90,000 less after 30 years, but still having $500,000 out of your 100.
It's pretty remarkable. It really is. Those are the questions. I don't want to call them basic, but they are in a way. But I think they're crucial. These kinds of questions and the answers that you give are crucial to understanding how buckets works.
So those are buckets 101, 102, 105, 110. And we'll get into the 200 block next time.
We'll take you to the advanced course next time. I found really what I did was I took a whole bunch of these questions that we gotten from buckets over the years and kind of had generated a kind of AI. Give me the most common questions out of these, and these are the top 5, and they're really good questions. These are really well done. So I congratulate our listeners, our longtime listeners, for being insightful like this. And I do hope for people, especially new listeners who may not understand how all the buckets works, that these are helpful. The next type of, I'll say, more advanced questions, which I think we're going to get into on the next episode as a kind of part 2. We're going to talk about the optimal length for each bucket's time horizon. Going to talk about the rationale behind spending safe money before stocks, and then integrating buckets with tax location, things like that, Roth conversion strategies. So, but even if that's more advanced than some people are necessarily asking right now, it's still a good discussion to have, and I want people to tune in. Professor, I know your voice has been struggling. I didn't even mention that at the top, but I don't want to keep you too much longer on this. We're going to let your voice calm itself over the next few days and do. But you did pretty well.
I'm trying. I'm very trying. I've been told.
You really do. Yeah. I mean, I can always count on Professor Plum to come do a podcast with me, even if he's not feeling that great. So I want to remind people that you can get in touch with Professor Plum or any of the Lucia Capital Group advisors. 800-644-1150, the number at Lucia Capital Group, 800-644-1150. You can also find them online at luciacap.com. Spell that out, LUCIACAP.com. You can find the stuff that we talk about here. You can also download at luciacap.com our guides. I would encourage you to do that. These are very popular guides, and we've got as many of them as you want because all you got to do is download it. Go to luciacap.com. You can type in bucket strategy in the upper right search bar. It'll give you our guide on the bucket strategy. Many of the things that we talk about on this program are there, and you can read it. It's about 20, 30 pages. Read as much of that as you like and understand how these things work. We also have a Social Security guide. We also have an estate planning guide and a retirement income guide and a couple other things. So check it out there at luciacap.com. Make sure you subscribe to this podcast, because if you didn't subscribe to this podcast and you didn't know about this episode, you would have missed just all this golden information. So make sure you subscribe. Go to Apple Podcasts or Spotify and click whatever button you need to click to subscribe. I think it's a very easy thing to do. And make sure that you listen to every single episode of this podcast, including our next one next week. I rarely do this. I rarely set the next week's topic, Professor, but I've done it. So we're going to have to talk about this. Not that you need brushing up, but I'm giving you the heads up for it. So hopefully that works. And you'll be all better next week. Thank you, Professor. I do thank you very much for being here.
You're welcome.
We will talk to you again next time. For Professor Rick Plum, certified financial planner professional and accredited wealth management advisor, I'm your podcast host, Johnny Dean. Thanks so much for listening. Managing your financial future. Talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice. It is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. Annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Alternative investments may not be suitable for all investors and should be considered as an investment for the risk capital portion of the investor's portfolio. The strategies employed in the management of alternative investments may accelerate the velocity of potential losses. CDs are FDIC insured up to $250,000 per deposit or per insured bank for each account ownership category. It is important to keep in mind that investments in fixed income products are subject to liquidity, interest rate, financial inflation risks, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government but are subject to inflation risk. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you're required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. The information provided is based on current laws which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. LPL Financial Insurance License Number 0518721. LPLIA Insurance License Number 0B91442.